right, folks, welcome to the best decision any trader can make in their trading career. CIC, being in CIC, this is the only official place to learn about CRT on the entire internet. In the sea of fake mentors, in the sea of fake, phony, posing so-called CRT mentors, obviously, none of them know what they're talking about when it comes to CRT, right? The only correct place to learn CRT is the source. Don't come to me saying it doesn't work. Don't come to me complaining about the concept if you went to learn it from someone else. If you went to learn it from someone else, then go complain to them, not to me. Right? Because if you learn from me, and I've trained many hundreds and thousands of successful traders from all different races in life and positions and social status. The best traders have one thing in common. Those who train under me, of course. They focus solely on my information. As soon as you include someone else and you start receiving concepts from multiple sources of information, you get distracted and you go down a spiral of confusion and you just quit. And that's happened to many people, right? So be careful. The CIC content is 4 chapters. Chapter 1, everything you know is a lie. Chapter 2, stop thinking and start analyzing. Chapter 3, more trading, less drawing. Chapter 4, you are the captain of your ship. The sequence of the chapters is not random. You have to watch them in order. All right? So chapter 1 is going to prepare you for these 2 chapters, 2 and 3, which are extremely technically dense. Which are then, you tie up all the information you learned from the first 2 chapters in chapter 4. All right? One by one. Everything you know is a lie. 3 sub-chapters. Welcome, the reality of trading, and how to capitalize on the market efficiency paradigm. Everything is designed to distract you, especially in our digital age, right? With the majority of the population scrolling TikTok and Netflix and YouTube all day long. And for those of you who can watch in the next 5 and 10 years, yes, those are the apps which are famous in 2025. They're all a distraction. The outings, the fun you have with your friends and family, it's all a distraction. Take control of your attention. I've trained many successful traders, and they range from doctors and lawyers and engineers and CEOs of companies, CME traders, actual CME traders coming in and asking me how the stuff I do works. And I reached a conclusion, which is trading is a much tougher profession than even medicine. I've had many doctor traders tell me that. Right? So this is not a casino. This is a professional setting. You're trying to become a trader, a professional trader. Right? This is no different. In fact, I would say it's even harder than being a professional anything else. And you'll see why. In CIC, we're going to be tackling smart money and how they manipulate the market. The reality of trading. 100% of you will fail. All of you. Inside CIC, those who are watching it years and years after, right? You're all going to fail. It doesn't matter if you fail, right? Because a failed trade is nothing more than one step in the right direction, right? So you're all going to fail. You're all going to lose trades. You're going to lose money. It's going to hurt. It's part of the game. I'm not here to sell you some rented G-Wagon, rented Lambo, beachside mansion dream. I'm here to teach you how to be a professional trader. Now, there's a lot of money to be made in professional trading. You can become extremely wealthy and gather huge amounts of money from trading. But you will only do that realizing that most traders lose. "99% of what you see online is nonsense. And you better have a notepad writing down everything I'm saying. All the rented Lambos and rented G-Wagons, rented girlfriends, all the mansions, all the demo accounts, all the profits, all the payouts, all the bank statements, 99% of what you see online is pure garbage. It's designed that way to sucker in noob traders, right? Look at my Lambo. Come join my course, right? Which is why you never see me flex, even though I could. I could flex if I was that kind of person, but you would never see me flex cars or money or whatever, right? Because that doesn't matter. What really matters is, can the person you're seeing provide you with value? Can the person you're watching give you something which you can use in your own trading? If the answer is yes, keep watching. If it's no, then discard them. Bearing in mind that 99% of what you see online is pure nonsense. Real trading is not going from excuse me. It's not going from $1 to $1 million. Real trading is not doubling your account every day. Real trading, and note this down, I purposely didn't fill up the slides. Why? So that those of you who are binge watching don't make use of this, right? Those who are noting down what I'm saying, writing down every word, are those who will advance the fastest and make the most progress, right? So real trading is the action of using money to generate money. Let's say you have $10,000, a decent amount. It's not big. It's not too small. It's small, but it's not too small. The average trading account, $10,000. And there will be a section in CIC speaking about growing small accounts, right? But that's for later. The purpose of trading is to use money to make money, to make a small percentage gain every month, which accumulates over time. And you're going to depend on the magic of compound interest to do the heavy lifting. That's how you build wealth. You don't build wealth by chasing doubles, by chasing $1 million trades, by entering on a 1 minute order block and expecting it to run 10,000 pips. That's not what this game is. That is what you see online, which is garbage, which induces the traders. This is how liquidity is made in the markets. By portraying the image of fast money, of get rich quick. And that's why most people, most traders, and I say traders lightly, are nothing more than gamblers minus the casino. right? So instead of gambling in the casino, you're gambling at home. How to capitalize on the market efficiency paradigm. By realizing you're focusing on the wrong things. This picture is all I'm thinking about when it comes, and this slide is where we get technical, right? When I look at charts, this picture is all I care about. You have the liquidity provider, smart money. And no, smart money is not the hedge funds. It's not the banks. It's not the institutions. That is dumb money, right? Smart money is the people who own the market. These markets are controlled and they're manipulated. And I don't care who tells you otherwise, they're wrong. These markets are owned, controlled, and manipulated. By who? Later. This is you and me and the banks and the hedge funds and the traders on Twitter and YouTube and everywhere. This is us. Every price move you see, every expansion you see happening, no one's causing it. You're not causing it. I'm not causing it. The hedge fund is not causing it. Remember that we're nothing more than fleas on a dog's back going for a ride. Right? So they move the market however they want in specific patterns, which we're going to try and learn to recognize. And no, you're not going to go and chase patterns blindly. You're going to look for the logic behind each price move, and that is how to catch the ride on the dog's back. Real trading. We've covered that topic right now. Just now. Excuse me. So this image, excuse me. This image is all I'm thinking about. You saw me enter a trade in Bitcoin a while back at 25,000. Excuse me, at $19,000 back near the bear market bottom. When I called that move, I was thinking about this. You saw me call the bear market bottom. When I called the Bitcoin bear market bottom, when I came at 16,000 and said it's going to explode upwards, then I had this in mind. Right? Every single trade, I have this in mind. This is the basis of all your trades. You're trying to capitalize on a movement that the market makers are going to cause. That's it. You are not trying to trade a pattern. CRT, model number 1, breakers, order blocks, turtle soups, FVGs, that all comes secondary to this. Liquidity provider, market mover, and willing and or unwilling liquidity. Here's some technicals. Now the market makers control the markets using highs and lows. So they push the market in a rally, they form a high, they dump it lower, and above old highs, we have buy stops. Above all lows, we have sell stops. Right? So you're going to wait for them to go and push market above the old high, forcing in new buyers and stopping out old sellers. Stabbing into the old high. Right? This is a manipulated move. Forcing participants in the market and then going the other way. Turtle soup. Right here. Bearish turtle soup. And vice versa. You have an old low, sell stops, old high, buy stops. And here we have a market structure shift, which didn't work out so well for the blind pattern traders. Right? So we're trying to recognize how market makers sucker in as many people as possible in one direction to move the other direction. That's all we're trying to do. It's that simple. All right, so sell stops, buy stops. They push price below the sell stops, stopping out everyone who was long all the way up. Adding in breakdown traders, at the low. So everyone got stopped out who was long. New shorts were opened down here, and that is the move. That is the liquidity that was generated enough to move the market higher. Right. So think of it as a game of who is the market maker trying to screw over next. Now I know what you're saying. You're saying, where's the charts? Where's the CRT? That all comes second. This is what matters. Understanding the market efficiency paradigm is all that matters. CRT comes second. The open, high, low, and close comes second. Everything comes second to understanding the market efficiency paradigm. Understanding how smart money, how the market makers, how they manipulate the prices in order to make a profit. Screwing over all of the uninformed, speculative, dumb money. Liquidity. That's liquidity. And the reason why I don't see many people going in depth on this matter is because they simply have they don't know. I happen to know some people who work behind the scenes, which is why I have a deeper understanding of how these charts work, which is why I came to have the highest accuracy in trading history by knowing this. And now you are about to know it too. You don't think about patterns. You think about where is the liquidity and why is the liquidity there. Think about the logic of the moves, not the pattern. Trade the logic, not the pattern. And that marks the end of chapter 1. All right, folks, before delving into the deeply technical chapters of 2 and 3, here's a quick run through to correct the terminology we use on a day-to-day basis as security traders. So on the right side, we have the PD array matrix with all the different key levels that we look for before entering a trade. Of course, in this hierarchy, the strongest key level or PD array is the bearish breaker and the bullish breaker. Right, so the breaker is the strongest PD array. And you better be having a notebook at hand, writing down everything I'm saying. The most common terms are candlesticks, FVG, breaker, kill zone, especially model number 1, turtle soup, rejection block, and OT. To begin with, candlesticks. Now, candlesticks are nothing more than a visualization of the buy or sell orders in the market at any given chart at any given moment, right? So thinking from the perspective of the market efficiency paradigm, a candlestick is simply the market makers injecting in more liquidity, pushing price to the buy side, which results in an up-close candle, or vice versa. They push market to the downside, which reflects in the charts in the form of a down-close candle, which means more sell orders, right? That's it. So open low, high close, which means the market makers are pushing price higher. Open high, low close, which means they are pushing price and they intend to attack liquidity lower. And as you know, as I always preach, we're looking to trade below the opening price of potentially bullish candles and above the opening price of potentially bearish candles, right? And note this down. Open, turtle soup into previous candle's low, CRT, and rally when bullish, and vice versa. Open, rally, turtle soup, and then dump. FVG. FVG is a 3-candle pattern which indicates one-sided heaviness in any given market, right? Which means the market makers are pushing price low so quick and they're in such a hurry to go down to attack a certain target that they're leaving these gaps in the market. And these gaps are rich and filled with leftover orders which need to be rebalanced. And that's the reason why FVGs are always sensitive price zones in the correct order flow. Right, so in a bullish candle, you'll see FVGs being wicked into. So a quick wick, FVG, wick and rally, CRT low, and vice versa. FVG bearish, they'll go and if it's a valid FVG, then you'll see the reaction. You'll see it dump straight down without spending too much time in the FVG, right? Which is an important factor. The speed from the key level. Next up, you have the breaker block. Now we have the bullish breaker and we have the bearish breaker. And the bullish breaker is the up close candle that caused the bearish turtle soup. Right, so it's one specific candle. Again, remember the difference between what we do and what the other schools of analysis do. We're not here trading zones. We're not here guessing zones. We're not here like the supply and demand traders, like the market structure, ETFX, all those clowns. We're not like them. We trade specific candles, not zones. All right. So the breaker is this one specific up close candle which caused the dump. As soon as you close above the candle, then the sensitive point in the breaker is going to be the closing price. It's always going to be that way. And this is one of the ways to achieve near to zero drawdown entries. Is the breaker's closing price, right? And go back in the charts, verify yourself. What I'm saying is the closing price of the breaker, of the valid breaker, is one of the best ways to get a zero drawdown to the pip to the tick entry, as you can see in this picture here, and vice versa with the bearish breaker. It's the down close candle that caused the bearish turtle soup. this one specific candle, preferably a thick, clear, visible candle before the rally. Again, we take the whole candle, and the sensitive point is always going to be the closing price of the breaker. Right, so it's going to be down on the bearish breaker and up on the bullish breaker. Usually, more often than not, that is where they offer you a zero to the tick entry, zero drawdown entry, which will be spoken about later in the next chapters. Kill zones only applies for day traders, and also applies for the weekly candle trader when trying to catch the high or the low, because the high or the low of the week usually forms on a specific day at a specific time, usually, more often than not, during a kill zone. A kill zone basically is a high probability trading window. It's a window of time in which price moves faster. We have three main ones: the Asian session, usually which we leave and don't trade. We watch what the Asian does in order to anticipate London. So the Asian session is 8 p.m. to midnight New York time. Whenever we talk about the algorithm, we're talking about New York time. Right, so whenever I say time, whenever I'm trying to tell you something on the chart, then the time that unifies all of us is New York local time. Right? That's the time which matters to the algorithm. So Asian, 8 p.m. to midnight. London, you have 1 a.m. to 5 a.m. New York, 8:15 to 2 o'clock. Now there are some adjustments which can be made to these times, but this is the rough estimate, and this was intended to be a quick, brief run through. We'll go in deeper into exactly what time to enter later down the road. Right, but for now, these are the kill zones. High probability time windows in which price moves faster. And a phenomenon for your study is session liquidity, which is, what does New York do when a turtle soups London's liquidity, and vice versa, right? So each session is taking the liquidity of the previous session and moving in a certain pattern. That's what we're trying to predict, right? So the market makers are using the sessions to generate liquidity, and they're using each session, to move the market in a certain way depending on which liquidity it took first. For example, if we had taken this high before this low, then more often than not, that would be a bearish sign. And vice versa. We took this low, they pushed price down below this low, they rejected, they closed above this candle, model number 1, rally. Next up you have the famous model number 1. Now model number 1 it simply refers to the up close candle that liquidated the high, or the down close candle that liquidated the low. This one specific candle, again, you'll notice this pattern in my speech, which is speaking about one specific candle in each trade. That's the precision we aim to have which is way above anything else. We go and dissect specific candles and pinpoint specific candles, not zones, right? Which is what makes the system better than other systems, objectively better and objectively more accurate than other systems. So a bearish model number one is an up-close candle that liquidated the high. You enter at the low, stop loss the high, and you let it dump. And vice versa. A bullish model number one is the thick down close candle that liquidated the low. You close above it, and then you use that single candle as a sensitive price point to enter. Now, what's happening in model number one, it's not just a pattern. It's the market makers pushing price, enticing new orders and new liquidity into the market, right? Because that's how they generate interest in the markets, is by pushing price higher or lower, enticing dumb money to get excited and participate in a trade in the false direction, right? So in this situation, they're forcing price above the old high, enticing new longs, stopping out old shorts. And as soon as they close below this one specific candle, they're showing intention of using this one specific candle as the trap and as the propeller to push price into the other way. So they push price into the high. They lose money temporarily, pushing price up in here. They close below, and they have to push price back into this one specific candle in order to push price lower, right? They can't go lower unless they go and mitigate the risk that they have by pushing price into this one specific up close candle that liquidated the high, and then they're forced to push lower, which is also CRT. Right, now that was a bit too, I went a bit deeper than I was intending to in the summary. But in plain English, bearish model number one, up close candle, liquidated the high. Bullish model number one, down close candle that liquidated the low. Next we have turtle soup. Pretty simple. So we have buy orders, sell orders, market makers pushing price above the old high, stabbing into the buy orders to entice new longs and to stop out old shorts. And once they have this move done, then they're going to offload the positions they gathered up here and dump them and distribute them to this old low, right? So market makers, they need old highs and lows. This is the advantage we have over them, is we'll know that they will always need our highs and lows in order to accumulate, manipulate, and distribute. You can't manipulate unless it's above an old high. There will always be old highs and lows, which they need and they engineer and they manipulate above and below in order to make money, right? So this is the advantage we have, which will never change unless the markets are taken away from us, unless we can't trade anymore. That's when it's gone, which is not going to happen anytime soon. All right, and vice versa. Bullish turtle soup, they engineer a low. So this low, price pushed away from this low, right? So they propelled price away, generating automatically. You can assume when you see price moving higher that there's sell stops below it, right? Below the old low. They push price down into the old low, stopping out everyone who was long, right? Adding new short positions in the market, and then using that fuel to push higher and make some money. They make some money out of the retail traders, right? So that's basically turtle soup. Rejecting old high or rejecting an old low in plain dumbed down English. Rejection block. It's a nice one. It's the closing price of the candles, the closing price of the order blocks when they leave either a stubby or a long wick. Right. This will be discussed in detail in the lesson Price Action Details later. But it's basically when you see an order block with a long wick, right, then you're going to go and mark the opening price, and that usually is the sensitive zone which they use to stab into, stop out retail without taking out the wick, and then dump, or vice versa. So retail and dumb money turtle soup traders, they think, you know what, I'm going to wait for this low to get taken. But no, the body is enough. They take the body and they rally. OTE. OTE is basically a golden zone Fibonacci pull, which is terms which I don't expect any ICT trader to understand, because they're all just blind cult following sheep, which can be a good thing, right? But the way they're pushed into watching his 50,000 hours of videos for his own benefit, right? And I mean ICT. That's what I have an issue with. So, excuse me for the rant. The reason I'm bringing this up anyway is their lack of critical thinking skills. You can know what an OTE is by simply Googling Fibonacci golden zone, right? That was where the OTE was taken from and repackaged, basically. But the good thing is, and I digress from that little mini rant, the OTE is a lot more simplified version, which is easier to understand, as you'll see right now, which is basically low, high, low, right? So you have a low, you have a high, you have a lower low, and then you have a higher high, which closes above the high that broke the low. Right, so once again, snap out of it and focus. Low, high, lower low, caused by the high. And then the high that broke the low, you're going to close above it. Once you close above this high, close convincingly, then the games are on. The bullish games are on. You wait for a pullback, and this is the OTE. It's the pullback, right? So it's a deep retracement, which they use to scare away people after the market sentiment has shifted from bearish to bullish, or vice versa. So as soon as this happens over here, we have switched now to bullish. And this is a mid-lecture reminder. If you're strayed away, or you got distracted, or you went to sleep, then wake up and focus. Back to noting down the important things, which is low, high, lower low, close above, higher high, and then after this close, this is where dumb money buys. Above old highs. And even though they're right about the direction, they get viciously taken out of the game, and then it rallies, right? So the OTE in basic terms is the pullback used by the market makers to scare away people who are on the right side of the market, but they're not familiar with how the market moves. And it must have happened to you. At least all of us have suffered and experienced this once. At least once is you were right that the market is going to go down, but you kept on waiting for it to go down from here, and you shorted down here, you sold down here, and then it went up. You then doubted your analysis, only to be proven right at the end. Right? So you were right, but you were unfamiliar with how price moves, which is why you made no money. Right? So again, high, low, higher high, dump down viciously, OTE, which is a 50% to the 75% Fibonacci level. That's what I consider an OTE. And I even extend it over to the 0.886 Fib. Right, so anything after the market structure shift, and the OTE is one of the most beautiful trades you can take. One of the most surefire, beautiful trades you can take it's the deep retracement after a market structure. And note this down. OTE is defined as the deep retracement after a market structure shift, either bullish or bearish, designed to scare away the people who are on the right side of the market. Usually lies from the 50% Fib all the way down to the 0.886 Fib of the price leg. Right, so leg 1, retracement, leg 2, OTE, vice versa. Leg 1, retracement, OTE, kickstarts leg 2. Right, so they distribute in 2 legs, 2 expansive price legs. Expansion leg 1, once you see this, then you're almost guaranteed, and there's no guarantees in the market, but there's a high chance that you see a leg 2 kickstarted by OTE. Right, there you have what's that? There we have a rejection block. To finish off this terminology lesson, which has gone a bit farther than I wanted, SMT. Now, SMT is when one asset class takes the low, the CRT low, and the other asset class doesn't take the low. And that usually indicates heaviness in one specific asset class over the other. And this is a concept first developed by Charles Dow back in the late 1800s. It is not an ICT concept. It is not a new magical IPDA SMC invention. It's old as the hills. Right, which is the idea that the market makers are going to push price below one specific low and not the other one to send each other a signal that the bottom's in. Right, so in plain English, SMT is one asset class taking the low, and the other asset class is not taking the low, which indicates weakness in this asset class and indicates the lack of desire to go any lower. Right, so this is the cheapest they want to offer this asset class. Right, so all right, folks, welcome back to chapter 2. Stop thinking and start analyzing. And this chapter is specifically targeted at those who like to theorize, but they lack the practical skills of applying the concepts in theory. Let's start slow. And I hope you're not binge watching this like you would a Netflix series. Now, one thing I can't do is I can't force you to study this content properly. What I can do is offer the best explanation that there is of CRT, which is what CIC is. Right, and later in the CIC upper class, personalized teaching for a small group of people. But in CIC, I offer you a detailed explanation. If you listen to it and you follow the instructions, because this is a manual, right? Perhaps maybe later in a year or 2 or 3, I don't feel in the mood to teach. Even I sometimes go back to my videos because they're nothing more than manuals. It's not my opinion. It's not something I think is right. It is the objective facts gathered in one place. Right? It's an investigation I made, and after making this investigation, all the facts were gathered in one place in the form of CIC. And later the CIC upper class, or any other educational video you have of me on YouTube, on Telegram, whatever it is. All my YouTube videos, or all my Telegram videos, all my mentorship videos, they are trading manuals. I can make them the best way possible, which is how they're done. And if by now you're saying, come on, just get to the point and tell me CRT, then no. Wait, shut up and listen. Right? I can't force you to watch these videos and take notes and apply them the correct way, as you should. I can't deter you from simply binge watching, with the bag of chips, some popcorn. Let's watch what Dr. Romeo is saying right now. I can't deter you from that, and I can't force you to do the right thing. But what I can tell you is remind you that the best way to make the most value out of these videos is by watching them as you would a university lecture for an exam, not the way you would a Netflix series. Right, so that being said, the charts are divided into an X and Y axis. The Y axis showing us price, and the X axis showing us time. Excuse me. 90% of market participants or more, they never in their life as traders, they never look past the y-axis. And due to the fact that the majority are always wrong, that alone tells me the importance of the x-axis, the importance of paying attention to time, not price. In fact, CRT was one of my 2 private models, which I never intended to release ever. But now I have one of them. The other one is a model I use to trade only. It's my personal model, and don't ask me for it. I'm not going to share it. It's a model where I use only time with no price. And we'll see more about that in a minute. So what's CRT? CRT stands for candle range theory, which basically means every candle's a range, which will either be broken out of or truly or falsely. Means every range you see is either going to be turtle souped as so, or broken out of, close below lower prices. Right, close above higher prices. Wick above lower prices. And this takes us back to the age-old if-then concept, which is wick above. If they wick above, lower prices. If they wick below, higher prices. If they close above, higher prices. If they close below, lower prices. Our job is to hunt the highest, the highest probability candle range and look to trade them. Stop thinking and start analyzing. Now, the importance of time. Time is more important than price. And let's prove that. All right, because everyone goes and blabs on social media and puts pictures of old wise Greek gods as their profile pictures while being a teenager. Right? If you know who I'm talking about. But everyone claims to know what time is. Everyone claims to have cracked the code of time and the algorithm. But the reality is as taught in lesson 1, 99% of these people are fraudsters. They have no idea what they're talking about. And listening to them does nothing more than damage your eyes and your brain even more and stray you away from profitability. The more you listen to these folks, the less likely it is that you succeed. And I've seen it many, many times. I've trained thousands and thousands and thousands of profitable traders, and the pattern I've seen with unprofitable traders is the fact that they keep jumping from one mentor to this guy to the third, to ICT, to DTFX, to the third and the fourth and the fifth, and then Romeo and someone else. I'm of the opinion that if you find CRT and turtle soup, if you truly find and understand and listen to me explaining CRT and turtle soup, and you still look for other things, or other people, or the strategies, or the explanations, then the chances of you succeeding are highly unlikely. Why? Because the sample size of people I have shows me that those who stick to one thing succeed. Time is more important than price. And it's nothing like these goofballs on Twitter act like they know what they're talking about. They don't. The demonstration that time is more important than price is as follows. Jason bought Bitcoin at the price of $10,000. Romeo bought Bitcoin at the price of $10,000. So they both bought at the same price. But the difference is Jason suffered a devastating 60% loss from his entry, while Romeo 4x'd, 5x'd, 6x'd his money. How? Because they both bought at the same time, at the same price, 10,000. The difference was the time they bought. So the price can be the same, but if the time is different, then you're either going to lose or you're going to win based on what time it is, not the price. And this can be demonstrated also on the lower time frames. Now we're going to go and run through the all the different levels of CRT, right? So the 4-hour, the daily, the weekly, and the monthly. 4-hour CRT. Every single daily candle is composed of 6 4-hour candles, right? Every single 4-hour candle, daily candle, is composed of 6 4-hour candles. All you have to do is find one valid CRT and trade it. And usually every single day, every single week, every single day you can have at least one 4-hour CRT. Now, this is a message only for the intermediate traders, right? For the beginners and the less advanced, you'll see something for you in the next chapters. And the highest probability of getting a CRT candle is going to be related to the 9 o'clock a.m. 4-hour candle. As you know, 159 is the division of the daily candle, which I made famous. Right, so 1 o'clock a.m. Again, what time is it? Which time zone are we following? The New York local time. Correct. If you said it, and if you didn't, then focus. Right, so 159. That's 6 4-hour candles a day. And each 4-hour candle can be imagined and seen as one daily candle due to and thanks to the fractal nature of price and time. Each candle on every single time frame prints the same exact way, which means the monthly candle is the 4-hour candle printing slowly, and vice versa. The 1-hour candle is many daily candles printing fast, which is why one of the best ways to practice is to trade as a beginner, to trade the higher time frame candle, but analyze lower time frame candles at the same time to gain experience. Right? Because if you analyze 100 hourly candles, then you've gained the experience of someone who's analyzed 100 daily candles without analyzing the daily candles. Now think about that for a second. Think about the fact that you're hacking time, basically. You're getting more experience than someone who's been in the market 10, 20, 30 times more than you have. 30 times longer than you have, excuse me. And this information, only knowing this information puts you at an advantage, because a supply and demand trader, an Elliott wave trader, a harmonics trader, a market structure trader, an ICT pattern trader even, they don't have access to this information. They can't take advantage of analyzing and gaining a lot of experience in a short amount of time, analyzing the lower time frame candles, treating them as if they were high time frame candles. And for the mental health of you, CIC member and watcher in the future, if you're watching this later down the road, 10, 20 years from now, for your mental health's sake, never go below the 4-hour time frame. Again, the 9-hour, it's a Forex chart, right? So 159. The 9-hour candle is this one. And what I'm looking for is for it to be a smooth, easy, one-sided candle, right? That's why the highest probability. Candle is the 9 o'clock a.m. New York time for our candle. At the 9 a.m. CRT model, the real 9 a.m. CRT model, not the Temu version, which has been spreading on social media. And now that I bring that up, I'm going to warn you from people who are more worried about their social media than they are about their bank account. And if you're watching right now and not focusing, then focus. I'm warning you about people who you'll see on Twitter and YouTube and Telegram. They will come. They are more worried about their social media statistics than they are about their bank accounts. They will chase clout using the name CRT. They will claim to be experts. They will present to you with different drawings. And they'll draw all sorts of theories and mostly, of course, watered down versions of my words and my teachings. And they will achieve successfully fooling those of you who are looking for a quick way out. I'm warning you against them. If they come and tell you that they're going to come simplify CRT, CRT is already simplified. And anyone who comes to you claiming that they know CRT, or they can teach CRT better than I can, or any of that nonsense, is a straight up liar. And they will do nothing more than hinder your performance, so avoid them. This is already me summarizing and making it super simple. Right? And this entire year, 2025, I've already told you I'm going to dedicate it to you, my students, right? To make sure you understand, each of you understands, as far as I can do, of course, because you're a lot. But whether it's through CIC, whether it's through the CIC upper class, you will all get an adequate education, an extremely high level education, for free, and in CIC, and of course the most intensive in the upper class, right? But the point of this mini rant is to warn you against CRT grifters and merchants who come to you with their hindsight charts. They come to you with their mysterious tone, which is basically copying me word for word. They come to you with their intention to either gain followers or open another cheap course or whatever. Avoid them at all costs and stay away from them. They'll do nothing. They'll do you more harm than good. Right? And you'll see the internet stuffed with them. And I have nothing to do with any of them. Now, there's a caveat. If they credit me for the work and you see them doing stuff I do and say, so they're basically copying my words and reminding you of my words, then sure, they're good. But if they bring new stuff up, if they invent, quote unquote, which is just bullshit, if they invent, and I say it lightly, new concepts, and you see them bringing up new CRT intricacies and details, then they're full of shit. CRT didn't exist a couple months back, right? Until I decided to reveal it to the world. Anything anyone knows about CRT is only what I've taught. I'll say that once again. For those who went to sleep, focus. Anything anyone knows about CRT is what I've chosen for them to know. And anyone who adds anything else, which I haven't, or acts like they know something I don't, which is even more absurd, then their work is rejected and you are ordered to abandon them completely. Right, so back to the 9 a.m. CRT model, the real one. So at 8:45, you're going to mark the landscape. What does this mean? This means you're going to go and see what the daily time frame candle is likely to expand towards, up or down. And you're going to mark a pre-9 o'clock high or low. And you're going to mark the 9 o'clock open. Right, those three factors, which are the three components of a high quality trade. And then at 9 o'clock, you wait for a high or low to be taken, turtle soup, and you wait for the formation of a model number 1, and you ride the wave. It's that simple. With, of course, an SMT forming between the two asset classes. Right, so it's that simple. No complications, no need for additions or innovations. All innovations are rejected. And they're designed to distract you and hinder your performance, no matter how juicy and enticing they make them look. Alright, so the summary of the 9 a.m. CRT model is at 8:45, mark the landscape, which means the higher time frame candle, a lower time frame liquidity pool, and the 9 a.m. open. You then watch. A common mistake made will be trying to force a trade as soon as 9 o'clock happens. No, wait for it to pan out. Wait to see what the market makers do, and then act. Always remember that we're nothing more than fleas on a dog's back, going for a ride. Alright, so we're watching. We're not pattern trading CRT. Right, we don't care about the pattern. We're trying to identify what the market makers want to do next. Next up, we have the daily CRT. Most famously, of course, in the week we have 5 different daily candles printing. Every single week, there's at least one daily CRT. Every single week. Which is a reversal CRT, by the way. Right, because every candle is CRT by nature. Either broken out of or turtle souped. Right, but every single week, you're going to find one of these. And notice how the 4-hour candle and the daily candle as well, they have the same aspect. So they all look the same. So whether you trade the 4-hour candle, it looks the same from the higher time frame, lower time frame. Daily candle, the exact same thing you see. Higher time frame, lower time frame. The same exact shapes and sizes. And I've done the same with the weekly. Higher, lower. And the purpose is to familiarize yourself with how the transition from a higher time frame CRT looks like on the lower time frame. Same with monthly. They all look the same. And this was done on purpose by me. This illustration of how they all look the same was done on purpose to demonstrate the fractal nature of price. So the monthly candle is nothing more than a slower 4-hour candle. Right. Back to the daily CRT. most famous model is the Monday CRT model. In summary, candle number 1, Monday, accumulation. Candle number 2, Tuesday, higher low of the week. As we know, Monday, Tuesday, Wednesday have an 81% chance to form the high or low of the week, with Thursday and Friday forming the opposing end of the range. Right, which is why it's interesting for us, and it's in our best interest to go and look for a trade to form with a range and model number 1 on Monday, Tuesday, Wednesday. To go even further, Tuesday, Tuesday has an extremely high chance of forming the high or all of the week. Right, so to narrow down the probabilities even more, you go from Monday, Tuesday, Wednesday to only Tuesday. So Tuesday is a special day. It's usually a rough day. It's usually a day which stops out a lot of beginner traders. So here's what the week looks like. Right? Ignore this. Just listen and imagine the weekly candle playing out in real time. Monday is usually a volatile up and down day, right? So it's large retracements, large movements, large sharp declines or rallies. And then you have Tuesday as a consolidation, goes up and down and stops you out. And then Wednesday is an easy day to trade. Right? Monday accumulation, manipulation, distribution. Again, this is a visualization of liquidity pools. So the market makers use Monday to set the sentiment for the week. They then go on Tuesday to upset the positions created during Monday, a timed range, and then on Wednesday they go and distribute back to the old high. Right, so on Monday, if you want to trade the Monday CRT model, then on Monday, as a beginner Monday model trader, and there are methods, and I know I lost some of you, but if you're still focusing, then good job. There are ways to trade all 3 candles. I can trade, for example, this candle down with whatever happens in between, and this candle, and this candle, and this candle. That's me. I have the ability to trade every single candle on the chart. But I don't. Why? To reinforce selectivity. You want to go and select the best setups. You don't just go and randomly enter any trade you see, because what that does is breed bad habits. Right? You want to be super selective with your setups, and the best way to do that is by timing your setups, which is another topic which we'll go into later. Now on Monday, do nothing. Simply mark the landscape again. Remember? What do I mean by mark the landscape? Mark the weekly candle's potential shape, mark a high or low, and then you mark the weekly open time and the daily candle trading's open time as well, opening time. You then wait for Tuesday to hit an old high or low, which is the Monday high or low, and then you look for a 4-hour model number 1, and you ride the wave if it's a weekly trade, or you look for a 1-hour model number 1 and you ride the wave. next up we have the weekly candle. And notice how they all look the same? That's the beauty of the fractal nature of price. They all look the same. The only difference is the speed they print at. And of course, the number of pips they offer. Next we have the weekly CRT and the monthly CRT. And the way to link these candles is with lower time frame model number 1 is monthly CRT, daily model number 1, weekly CRT, 4-hour model number 1, daily CRT, 1-hour model number 1, 4-hour CRT, 15-minute model number 1. Dissecting the 3 candles, C1, C2, C3, and CRT subtypes. Candle 1, candle 2, candle 3. This is the shape of an ideal CRT trade. Alright? Now, there are only 2 types of CRT candles. Or candles in general. There's a candle where it's better for you. It's more lucrative to buy below the open. And there's candles where it's more lucrative to sell above the open. That's the only 2 candles that exist. Buy below the open. Sell above the open. Sell above the open. Model number 1, FVG, order block, all of those patterns are nothing more than a way to ride the wave of a candle, which is better to be traded either from below the open or above the open. And listen to that once again if you have to. Candle 1, again, is accumulation. It's the market's moving in one direction. Usually, the bearish, and this is something I was speaking about before. Excuse me. That's God wanting me to not expose this information. Excuse me. Bearish CRTs are usually bullish candle number 1s. And vice versa. Bullish CRTs usually have a bearish candle as candle number 1. And go back and investigate that. Go back, and here's I'll give you a sneak peek. This is a bearish CRT, and it's a bullish candle, and vice versa. Right? See this bullish CRT? It was a bearish candle. So the color matters. It's not the be-all, end-all. It's not a fixed rule, but it's an observation. I advise you to go back into your charts and study. Candle 1, accumulation. Candle 2, manipulation. Candle 3, distribution. And a beginner trader might see this and just see 3 candles. But a veteran trader with a lot of experience can tell you that right here is the original consolidation of a market maker model at the CRT low. And the best market maker models, note this down, are the ones at CRT highs and lows. The best way to filter out, and this is why CRT even refines and validates market maker models. Original consolidation as a target is best and a higher probability when it lies at a CRT low. Right, so a beginner sees 3 candles. A more advanced student will see a market maker model over here with an SMR right there. And furthermore, an even more advanced student will see what's inside these wicks. Without going deeper, I know there's an OTE inside here. And notice how, just like magic, when there's a long wick, then usually they go and smack into the 50% of the wick, and then they dump. Right, but you can see inside this wick, and inside this wick. If you go inside wicks like this, usually you'll see a range and a turtle soup and a decline. Inside this wick, you'll go and you'll see an OTE. Right? Over here was the market structure shift, up here. Right, so if you go inside candle 2, you'll see that there was a market structure, shift to bearish, and then an OTE in candle 3. Only looking at the wick. So you can see the higher time frame candles from the lower time frame, and you can see the lower time frame from the higher time frame. CRT subtypes. Type 1 CRT. Classic, most favorable CRT type trade. Candle 1, 2, 3. Right, 3 candle model, which is also, by the way, stolen from something I taught before. Back in 2023, I think it was. I taught the world the 3 candle model, which was a primitive version of CRT. And you see some mentors nowadays teaching, and I say teaching very lightly because none of these people know what they're talking about. Right? I can't emphasize enough how full of shit these mentors are. And I can prove, if you were to see my DMs and see all these mentors in my DMs just a few years back, begging me to teach them, literally begging me to teach them, and names you'd be surprised, right? Huge names in the industry, massive names. Massive names which I only need to mention the first name, and you'll know exactly who they are. There's a reason why I put the bio as a mentor for your mentor. And it's that, in my DMs, it's the graveyard of all the trading mentors, especially IST mentors, who go and act like they've cracked the algorithm. They act like they're the best thing since sliced bread. They act like they've invented the wheel. But the reality is, they're nothing more than ex-beggars in my DMs for knowledge. Now, asking for knowledge is okay. You're supposed to go and literally beg. If you see someone who knows something you don't, then it's okay for you to go and literally beg them for it. Especially when it comes to knowledge, right? Not money. Because knowledge is power. If he can give you that knowledge he has, then he's transferring power to you. Right, but what's not good is you learning from someone, and then you go and you stab him in the back. Right, have some morals, have some principles, have some integrity. There's a saying in Arabic that comes to mind, which is, I teach him archery every day, and when his arm got strong, he shot me. Right, so asking for knowledge is fine. We all started that way, even me. What's not fine is asking for knowledge, begging for knowledge, and after learning, turning your back on your teacher. The sanctity of the teacher and the mentor should always be preserved. Excuse me. Which is why I get pissed off when I see, not pissed off, just I find it amusing, if anything, that these mentors have the nerve to come and claim to have discovered or invented something when it's nothing more than a rebranded, diluted version. It's not even better. It's a diluted, lower quality Temu version of what I have given to the world. All right, so here's the real 3-candle model right here. Of course, we're looking to trade candle number 3. And as you can see, inside here, there's a market structure shift happening. All right, I can tell it without even looking at the candle. And inside here, there's another OTE happening. You can tell without looking at the candle. And of course, a failure swing, which we'll be speaking about more in the later chapters. Type 2 CRT. This one catches people off guard and is the most difficult to anticipate, which is it's going to go in CRT high and low at the same time. Right, open, high, low, close. So dumb money CRT pattern traders will come and say, bro, it didn't work. Bro, look at it. It worked. Yes, it worked. You just didn't know, right? That's the difference. So don't come and say it didn't work if you're not even familiar with the whole with the details of the concept, right? I saw someone on Twitter a while back showed me a type 2 CRT as proof that CRT didn't work. While in fact it's proof that CRT does work and has subtypes, which you need to study. Type 2 CRT, candle 1 and candle 2 only, and that's it. Or vice versa, right? Bearish candle, bearish CRT is going to be a bullish candle. Type 3 CRT is candle 1 accumulation, candle 2 manipulation, and then candle 3 onwards distribution. So more than 3 candles. Type 4 is, and in type 3 you want to chase, you want to avoid chasing candle 2. Let candle 2 play out like it wants to. Right, let the market makers manipulate like they want to. Then you have an easier, faster candle in candle number 3. Candle number 4 is you have candle number 1. Then you have an inside bar, right, which means it doesn't go and hit in the old high. In candle number 2, rather they wait for another candle to go in turtle soup, upset the orders, manipulate, and then distribute. Again, you'll find through study and trial and error that the easiest candle to trade and the candle which will never change, whether you're watching this now or in 5 years, 10 years, the candle which will never change is candle number 3. Candle 2 inside candle, candle 3 onwards distribution. Stop chasing candle number 2. Trade what's readily available. Trade the fastest candle. The fastest candle is the candle which happens after the manipulation candle, and write that down. Type 5 CRT is they print multiple inside candles and multiple candles to each target, right? So the least favorable. Still tradable, because as long as you have this framework of this accumulation inside this candle, manipulation, then they're likely going to distribute to the other end of the candle, right? Range low, range high. CRT is nothing more than a range, right? It's a visualization of the range. Excuse me. Finally, you have type C CRT, type 6. Type 6 is also another one which messes with beginner traders and makes them doubt the concept. But all they should do is doubt themselves for not knowing the concept. right? So type 3 is candle 1, candle 2, and then candle 3, turtle soups, the turtle soup. This is the famous 3 drives pattern, right? Where they push price into one low, a second low, and a third low, with the exact purpose of stopping you out, right? This is the market makers at work in prime form. Low, dumb money buys now. Another low, dumb money gets stopped out and buys again. Another low, dumb money gets stopped out. The market makers purposely do this to push price below old lows, to stop out anyone from participating in the massive move that's coming. Yeah, Doc, that happens to me so many times. How can I avoid it? That's a topic for the next chapters. Finally, we've reached an important topic. Now, a common doubt I get is doubts from students that, hey Doc, you know what, I want to learn, but I'm afraid it's going to stop working. Don't be afraid. It's not going to stop working. As long as we have these CRT grifters, as long as we have dumb money, as long as we have pattern traders in the markets, these concepts will never, ever stop working as long as the markets are tradable and available to us. Once again, these concepts have been running since the late 1800s. There is no reason for them to stop working now just because a couple hundred people, 1,000 people know about it. Right? So that's not a genuine concern you should be having. They will work as long as the markets are tradable. If the market makers take away the markets from us and we can no longer trade them, then sure, that's not the case. Which I rule out temporarily for the foreseeable future. If I see any changes to that, then I will warn you all. Alright, I'll let you know. So the knowledge you have right now, don't go around marketing it. Don't go around trying to build a following with it. Focus on building your bank account rather than your social media account. Right? Focus on increasing the number in your pocket, not the number of people who follow you. They won't help you in anything. Right? I get the criticism I get. Oh, bro, you're selling a course, bro. I make tens and if not hundreds of times the amount of money I make through trading than I do through teaching. In fact, when I'm teaching, I actually lose money, right? Because I'm focusing on you guys and not myself. I'm not as locked in trading as I should be. But I do it for you guys. And I especially dedicate this year to you guys. And the reason I brought this up was to remind you all who might find it, you might find it enticing to build a social media group, whether it's to practice with others or whatever. But the best trading is done by yourself. The most money I've made trading was by myself in my room with nobody. Zero trade ideas, zero confluence, nothing. Just you, your charts. Everything else is noise. So don't go around marketing CRT. Learn it. You learn to be happy. You're learning. You're amongst the first people to learn. And I'm not sure how popular this will get in the next 5-10 years. But you're amongst the first to learn this. Stuff it in your mattress. Put it in a will for your grandchildren. Right, once you learn properly. And just keep it to yourself. There's no reason for you to go around marketing it and telling people to, hey, look, CRT, bro. There's no need for that. Right, so back to the butterfly effect model, which is one of my favorite models, which is a consistent high risk to reward model. Now, this isn't an advanced model, a preface. This is an extremely advanced model. A beginner who tries this model is going to get burned. Burnt alive. Right, so beginner traders, stay away from this. Intermediate traders, stay away from this. Advanced traders, give it a shot. The butterfly effect model is a consistent, the most consistent, high risk to reward model that there is. Right? In simple terms, and you'd expect something like this to have some geometry involved, but no. It's simply risking the lower time frame CRT candle to target the higher time frame CRT candle. The entry is going to be, model number 1 of the lower time frame candle, and implement candle profiles to increase success rate. Here's an example. And this is not some hindsight garbage, which you're seeing like you see from everyone else. This is someone who's called the markets, me, live more than anyone ever will. Who's proven his accuracy as a public 81%, a bit more accuracy publicly in a public setting. Which is why sometimes I fear that they're just going to shut my account down one day. Right? I've traded this model multiple times, numerous times in front of you all, live, but I never told you what it was until now. Right? The first time I alluded to it was in 2023, but I've never ever blatantly taught it like I have right now. So focus and understand what you're bringing in. Understand the power. Understand the excuse me. Understand the power of what I'm handing to you right now. This model is one of the fastest, of course, only for the advanced student, is one of the fastest wealth building machines that has ever existed in trading. And no, that's not me marketing. And no, that's not even an exaggeration. Because it's so simple, yet so mechanical, yet gives such an astounding risk to reward ratio. Here's a high time CRT candle, right? CRT high, low, type. That's the homework. What type of CRT is this? CRT high, low, rally. When you see a CRT on the higher time frame, then you can safely assume that the lower time frame has a model number 1 without looking, right? So ignore this. Just look at this. I can tell you straight away that there is a model number 1 at the low, on the lower time frame. And that lower time frame, model number 1, has a CRT. And that CRT on the lower time frame of the model number 1 has another model number 1. And this goes on forever until the smallest time frames, the 1 second time frame, the millisecond time frame, which the public doesn't have access to. Yes, it exists. Right, so the risk is going to be this lower time frame CRT candle, model number 1 inside here. It looks like a gamble. Oh, bro, but you're gambling, bro. It's the wick. No, it's not a wick. It's a model number 1 inside here. risk that, and the reward is going to be the higher time frame CRT high. Another example is over here, CRT, high, low. Again, let's practice what I said just now, which is I can already tell there's a model number 1 up here. Let's see if that's true. Yep. This one specific up-close candle. Now this is an unusual form of model number 1, which is why in this case you would enter where? Up here in the lower time frame model number 1. Because if you're going to wait for this one to go, for price to go all the way down and wait to enter at this candle's low, then the risk to reward simply isn't there, right? And this is what differentiates us from pattern traders. A pattern trader would say, you know what, yeah, let's wait for this one. Nope. We are trading the logic of price. We're trading the logic of how market makers move the price and why, not the pattern. The pattern doesn't matter. And up there, you'll find a model number 1 right here. So the risk is going to be the lower time frame model number 1, and the reward is going to be the higher time frame CRT. Targeting at first the 50%. Always target the 50% at first. All right, folks. Welcome to chapter 3. More trading, less drawing. 3 topics, which is what to do, what to look for when going hunting for setups, stages of development of a professional trader, and how to use trading to generate actual income whenever you want to. I would never push any of you to push live funds in an account, right? I'm not a financial advisor. This is not financial advice. But whenever you decide that it's the best thing to do to trade a live account, then this is how I use trading to generate an income. Now, before starting, if I see any of you who have a chart like this, full of garbage, then I'm going to instantly block you. Your chart should have nothing more than an entry, stop loss, and target. This is how you execute on a trade, all right? And this is what you anticipate. These are the feelings you go through before each trade, which is an important topic. If you are a theorist and not a trader, then this is an extremely uncomfortable zone to be in right now, right? When you trade live, when you go back in history, and history is a gold mine for those with eyes to see, and it does repeat itself. When you go back and back test, then you're really confident. You're like, yeah, look, it works. Yeah, 10,000 risk reward. But then when it comes to live trading and anticipating the candle, then you get really uncomfortable. If that sounds familiar, then it's normal. We all started that way, right? And the solution is this. Anticipate more and trade more. How to anticipate? At the start of a candle, right? Because as we know, you want to choose one candle you trade. That's the whole summary. Before it opens, you will mark the candle you're trading's opening time, not price, key level, and a pre-opening time liquidity pool. You will avoid trading the first third or the first quarter of the candle and wait for a manipulation to occur. Once they push price into an old low when bullish, or an old high when bearish, Wait for your entry model and execute fearlessly. Seek looking for the pattern, and I say pattern lightly, right? It's a logic. Seek looking for the pattern open, turtle soup, / key level expansion, right? Which is a more precise way to look at accumulation, manipulation, distribution. Now let's visualize this, because some of you right now, your brains are cooking. You're like, what are you talking about? Let's visualize this. When I go hunting for a setup, then I'm looking for open key level expansion. That's it. Open key level expansion. Open turtle soup expansion. Open SMT expansion. All the same thing. Right? Basically an open goes down and then up when bullish. Open goes up and then down when bearish, using the if-then principle. So your trades are going to look like this. And this is an extremely detailed, nuanced look, which you will rarely, if ever, find someone talk about, right? You mark the opening time, you mark liquidity pools up and down, you mark a key level when bearish. Then you'll see this happen if you're right. Right? It'll go up. Let's imagine this is a Tuesday or 9 o'clock a.m. Right? 9 o'clock. It goes and rallies up. It creates model number 1. And it dumps. Market structure shift. Remember? A true, real market structure shift. And we'll go in depth on that later. Real in depth. Right, so basically you go and you anticipate the key level which you expect will repel price and trade it. But Doc, what do I target? You target the 50% first, and then the opposing end of the range. Range high, range low. Typical standard range theory. Beginners, trade the weekly candle. If you're a beginner watching this, whether it's right now or it's 10 years down the line, beginners only trade the weekly candle and analyze the daily and 4-hour CRTs. Intermediate, trade the daily candle and analyze the 4-hour CRT. And a mistake some of you make is thinking you're advanced. You're not advanced. Don't cheat yourself of learning properly by labeling yourself as an advanced student if you're not. Right? That's you simply cheating yourself of improvement. Don't do that. Be fair to yourself. If you really want to improve, and that's what I advocate for, which is seeking improvement at all times. If you really want to improve, then the first step is realizing how good or how bad you actually are. All right? Intermediate, trade the daily candle and analyze 4 hours CRT. Advanced, which is very few of you, trade the 4-hour candles and daily, or weekly if you like. At this stage, at this level, it's your choice. And practice with 1-hour CRTs and below. Practice analysis. Stages of development as a professional trader in the future, if you choose to. You first yearn, then you learn, and then you earn. Right now, you are in the learning stage. By watching this video, you have entered the learning stage. And the learning stage is the longest, most drawn out, most boring, lonely. It can get really dark. You feel like no one's with you. You feel like no one's by your side. You feel like you have no one's support. You feel like, should I quit? Should I continue? What do I do? But once you leave this stage of learning and all the losses that occur within it, and all the sleepless nights, all the every centimeter of baggy eyes you get from this stage, it's all compensated once you advance from learning to earning. It's always worth it at the end. Whatever you lose, you make back. All the unclarity gets clarified. It all clicks. You get that aha, that light bulb moment, and it clicks, and you then realize that you've now earned something. You've left this stage of learning after losing tens of thousands, perhaps even hundreds of thousands of dollars in some cases, perhaps even more, millions of dollars. Some people have lost, which I know personally. I know a friend of mine personally who lost a couple $1 million in trading. And he's still learning with me today. But the advancement from learning to earning is the sweetest feeling in the world. You can never experience something. I can't even begin to describe it because it's something you need to experience yourself. And I hope and I wish the best to all of you. And I wish all of you experience the sweetness of transitioning from being a learner, a losing trader, to being a profitable trader. You then realize that you have a skill for life which nobody can ever take from you ever. It's yours now. Once you learn it, it's yours. It's a skill you've acquired for life. It's like learning medicine. I'm a doctor, right? It's like being a doctor off the charts. It's like being an engineer. It's like a trade. But first, you must submit, you must suffer, you must lose, you must be confused, and then it'll click. For some faster, for some slower, for some never. Analysis is not execution. They're two different things. And I don't want to leave you on the bad note, but I promise you it gets better. How to use trading, excuse me, how to use trading, and my throat is killing me. How to use trading to generate income. By understanding the three most important parts of execution, which is journaling, risk management, and risk to reward. All right? Journaling. Every single profession has some sort of a journal. A doctor, me as a doctor, for example, I have the informed consent, I have the medical history of my patients. I'm required and obliged by law to fulfill that journal. Same with an engineer, an architect, a lawyer, even a cashier prints a receipt, right? So every professional in all fields of life, every profession has some sort of journal. Professional trading is no different. You need to have a journal in which you journal your missed trades, your winning trades, and your losing trades. Your journal serves as support for you when you're down. Right, when you're down and you feel like it's not for you, you go on a tilt streak, you go on a losing streak, which all of us will go through, by the way. Every single trader, no matter how accurate he is going to go through an 8 trading loss streak. Losing streak. Right? So all of you and me and ICT and Gan and Wyckoff and everyone's going to go through an 8 trade losing streak. It's coming. It's coming for me. It's coming for you. It's coming for everyone. And when it happens, it's an extremely depressing time for your life. You feel like it's over. You feel like, is trading for me? Should I even continue anymore? But the journal helps you, because you'll look into the journal, you'll see the trades you took, you'll see those monstrous, extremely accurate, precise trades. You'll see the money you made in the trades. You'll flip through the pages of the journal and see how good you were, and it'll help you power through the devastation of the loss. Which, by the way, if you have good risk management, then no loss will affect you. Enough to depress you, at least. Right? So the next leg of the three-legged chair of professional trading, when you choose to, is risk management. Risk management refers to the amount of money you lose per trade, percentage-wise. You should never risk more than 1%. Ever. The photo says 2%, doctor. You should never risk more than 1% ever. Anything more than 1% is gambling. Right? So, yeah, but how do I flip my account, doc? Believe me, if you get basic, like 1 to 3 RR setups, and that's 3% gain per trade, 5 trades a week, for example, as a day trader, or even three trades a week. That's like 9% a week, 40% a month. If you think that's bad, then you need to go and recalibrate your expectations of the market, because this is not a casino. This is a professional trading environment. Right? This is a profession, not a hobby. Right? So, and if you get 50% per month, which I'm in no way advocating for, you've seen me take accounts a lot more than that. But that's at my level. The stuff you can do with money is mind blowing. You've seen me take $1,000 to $25,000 in a week, for example. You've seen me take $25,000 to $100,000 in a week, for example. The old students have seen even more incredible feats of trading and compounding money. But that's at my level. Even 50% a month, which, by the way, is an extremely impressive number. 50% a month blows every single fund manager out of the water. Right? Most fund managers, they promise you a return of like 10, 12% on average. Right? If that. So understand the game. Understand the parameters. Flipping an account from $20 to $100 or $1,000 is not the purpose. The purpose is to generate a stable income every month, as stable as possible, using trading, and slowly and progressively increasing increasing the percentage gain month by month, year by year. Right, that is what professional trading is. RR. Now, the beginner trader thinks that you need a 90% win rate and a 1 to 10 RR, as is always demonstrated on social media. And that is completely false. That is nothing short of bullshit. In fact, with a simple 25% win rate, with a 1 to 3 payout, which means you risk $1 to gain $3, right? If you risk $1 to gain $3, which is framing a 1 to 3 RR setup, which is fairly simple, using what I've taught, you can be wrong 75% of the time and make money. Now think about that. You'll trade 10 trades. Out of every 10 trades, 7.5 trades will be wrong, you'll fuck up, and you'll make money. If that's true, then ask yourself what you've been doing through your whole trading career so far. Gambling it away. Gambling away tens of thousands of dollars. Tens, if not even hundreds of thousands of dollars. You gambled away with no system. If you had to pay, or if you just learned without even paying, a correct system of managing your money, then you would have saved hundreds of thousands of dollars. Tens of thousands of dollars. Simply knowing this fact, which is the power of risk to reward and pairing it with a strike rate, no matter how low. And believe me, if you have a 25% strike rate, then you need some help, right? It's rare to find someone who's studying under me who has a win rate below 50%, right? But the reason I bring this up is for you to tickle your brain a bit, right? To give some food for thought. If you can make money and be profitable with a 25% win rate, which is a 75% loss rate, right? A 25% win rate is a 75% loss rate. If you can make money doing that with a simple 1 to 3, imagine what you can do with a 50% win rate with the same 1 to 3 or a 60% win rate. Imagine increasing the risk to reward 1 to 5, 1 to 6, which is also fairly simple. Imagine suddenly making money doesn't seem that far off, does it? But all you have to do is fix your brain, fix the way you think. You don't go in and max leverage full port. Just gamble your accounts away. Account after account after account. Until when? Until when do you plan on blowing away accounts? Until when do you plan on, in exchange for a dopamine rush, literally burning your hard-earned money? Just burning it away. Not even a casino, stuck at home in front of your screen. Right? So, get a grip and pay attention. This is the only purpose any of us has got into trading, is to make money. Correct? Correct. This is how it's done. Understanding these 3 things: journaling, risk management, and risk to reward ratio. These are not the same thing. This is summarized in, and let's summarize this whole lesson. Journaling is summarized in miss, journal, catch next time; win, journal, repeat; lose, journal, avoid. And you better be writing down intensive notes. Risk management is summarized in risking 1%, no more per trade. 1%. Risk reward is defined by you can make money having a 25% win rate, which is also, by the way, a reason to, if you see someone mocking someone for being wrong on their live calls, like seriously, I sometimes in satire, because I pride myself in accuracy. You may see me doing it. But if you see someone genuinely criticizing someone and belittling them as a trader for being less accurate, then they are not a profitable trader. A profitable trader never makes fun of someone for not being wrong, because they understand this table right here in front of you. They understand that you can make money while being wrong 75% of the time, and that's all that matters. It doesn't matter how flashy you look when you call the top or the bottom. It doesn't matter how flashy, how many followers you have. It doesn't matter how many subs you have in your Telegram group. None of that matters. All that matters is, did you make money? When it's all said and done, all right, folks, welcome to chapter 4. You are the captain of your ship. Fool me once, shame on you. Fool me twice, shame on me. You all made money. All of you in this group have made money. I've made money. You made money. The most beginner of beginners makes money. Right? Making money is not the issue. Keeping the money you make is the real issue. Right? It's the real account blower. It's the real profit eraser, is keeping money. Now, we're all humans. We all commit errors. The only person who doesn't commit error in this group is God. Right? Otherwise, even me. Sometimes, I commit errors. It's normal. And the insurance we have against these errors we make, which we are bound and destined to make, is the previous chapter: journaling, risk management, and risk reward. Right? Those three things are the insurance we have, the only insurance we have against doing what we are naturally going to do anyway, which is be humans and make mistakes, commit errors. Now, the essence of profitable trading and progress, because you're all advised to keep seeking improvement and progress, is, and I understand this is a lecture with less words and me talking. It's purposely designed that way for you to focus, right? Especially on this one. So put everything aside and focus on my words. If you already are, then well done. The essence of making progress in trading is eliminating your mistakes, right? Win, journal, repeat. Lose, journal, avoid. Miss, journal, take next time. Some of you, even though I emphasize, you will disregard at first the importance of journaling, and you will jump straight into trading. You'll get burned, and then you'll come back and say, you know what, he was right. You're right, Doc. So many times, every single day. You were right, Doc. I should listen to you in the beginning. You will go, if you ignore this advice, you'll go, you'll get burnt hard, and then you'll come back. And then you'll journal, and only then will you make money trading. All right, so this subtopic is to emphasize the importance of eliminating your mistakes in your trading. When you make a mistake, it can become really uncomfortable to confront the mistake, right? You feel like you just want to get rid of it and escape from the mistake and go and jump and be right again. But this is not a game of being right. It's a game of making money, right? It can get really uncomfortable being wrong and going into drawdown. And battling drawdown is one of the most uncomfortable feelings that a trader can go through. Making money is easy. Making money and being euphoric from the win, it's an easy, happy-go-lucky everything's fine, sunshine and rainbows feeling. It doesn't take effort to master being euphoric after a win. It does take effort and skill to ignore drawdown and ignore the feeling of sometimes it might creep onto you, whether it's from your childhood, whether it's from your personal life. You'll get a feeling of inadequacy. You feel like you're a bad person, or you feel like this really uncomfortable, gloomy feeling. It can even reach depression to some people. I know some people who've taken their lives in these markets. There's many levels to how drawdown affects each person, which is why the golden standard of dealing with drawdown is realizing that it's only numbers. It's numbers going down, numbers going up, numbers going down, numbers going up. The same way the numbers went down is the same exact way the numbers will go up. You're not a bad person if you lose. You're not less of a human being if you lose. It's normal to feel uncomfortable. You have to really go and get used to the cloud of discomfort produced by drawdown and losing, right? And you need to learn to detach from that cloud of gloominess and depression that comes with drawdown. And you need to graduate from that into thinking like the market makers, thinking like the algorithm, right? It's numbers going up, numbers going down. It's simple math. All right, so next time you're in a drawdown, don't take it too harsh. Chin up. Realize it's just numbers, and you'll live to see another day. Introduction to the CIC upper class. It's going to be brief. The CIC upper class is a high-ticket, ultra-exclusive private group within CIC only, which consists of 9 members only, which means out of all of you, I'm only going to be choosing 9 members, right, to be part of this high-ticket community, to focus on them in an ultra-personalized manner, right? Doc, how do I join? Let me join now. Nope. It opens in February, and you can only join after finishing the main CIC content, right? Then you come, and I sit down with the 9 of you in an extra personalized manner. And that's the CIC upper class. I hope you found that insightful. I wish you good luck, good trading, and to appoint yourself for the CIC upper class, text me or my assistant with simply writing the words CIC upper class. I wish you good luck, good trading, and see you in the secret chapter in the group chat. Bye-bye.